Welcome to today's Explainer. We are jumping straight into a full-blown autopsy of a spectacular corporate collapse, and we're going to do it using pure, objective data. We're breaking down exactly how a seemingly unstoppable financial strategy hit an absolute brick wall. We'll be looking at the hard numbers, the SEC filings, and the actual academic research that predicted this whole mess.
Let's kick things off with a brutal reality check. Nakamoto Inc. watched its stock plummet a staggering 99% from where it was trading just 1 year prior. We are talking about a high-flying stock cratering to a mere 16 cents a share by May of 2026. Let's be real, this isn't just a market dip, this is a near-total wipeout of shareholder value.
And cementing that total price collapse was a massive $238.8 million net loss reported in their Q1 2026 financials. For a company that was heavily hyped as a pioneer in digital asset treasury management, dropping almost $250 million in a single 3-month window is, well, it's a giant flashing red siren.
Section 1. The 99% crash. So you might be wondering, how does a Bitcoin treasury company actually end up in total freefall? You've really got to look under the hood at their core business mechanics. The scale of the mismatch here is just mind-boggling. In the first quarter, Nakamoto racked up $128 million in operating expenses, which absolutely devoured their tiny $2.6 million in revenue. That is a brutal operating gap. And to make matters worse, they got hammered by a $102 million loss simply because the value of Bitcoin dropped over that quarter. It was literally a perfect storm of skyrocketing costs and plummeting assets. But here's a twist that adds a really concerning layer to the story. Despite these catastrophic losses, company ownership stayed incredibly concentrated at the top. You've got insiders like CEO David Bailey and colleague Sullivan Bailey holding onto massive stakes. Combined, it's over 32%. So while everyday retail investors, who made up over 43% of the shareholder base, took the absolute brunt of that 99% crash, corporate control remained tightly gripped by the very executives overseeing the disaster. Now, you can't stay listed on the NASDAQ if your stock is stuck at 16 cents. To survive the exchange's minimum bid requirements, Nakamoto's board pulled a desperate compliance lever, the reverse stock split. It's important to understand that this doesn't fix the underlying value of the company. It's practically cosmetic. It's just a structural adjustment to artificially pump up the per-share price and keep Wall Street regulators off their backs. Specifically, they went ahead with a 40-for-1 reverse stock split. They literally shrank their 696 million shares down to just 17.4 million. Boom, the stock price is artificially pushed back above that critical $1 mark. But remember, this maneuver is totally hollow. It changes absolutely nothing about their market value or those terrifying operating problems we just talked about. It's a band-aid on a bullet wound.
Section 2. The infinite money glitch.
Okay, to truly grasp the root of this collapse, we have to put down the corporate filings for a second and look at the actual financial theory behind their strategy. Why build a company this way? Well, in a really groundbreaking research paper, academic Co-Pierre George maps out the mechanics of a strategy he dubs the infinite money glitch. It's basically a self-reinforcing debt cycle. When the market is up, it looks like pure magic. But as George explicitly warns, it has deep, fatal fragilities built right into its foundation.
The glitch runs on a specific 4-step loop. Step 1, issue convertible debt to raise a ton of cash. Step 2, take those proceeds and buy a highly volatile asset, in this case, Bitcoin. Step 3, because your balance sheet is now stuffed with Bitcoin, your company's own stock volatility shoots through the roof. And step 4, that extreme volatility makes the conversion options in those bonds irresistible to hedge funds. This allows the firm to issue even more debt on favorable terms, and the whole cycle starts again. It is an absolute leverage machine.
In Nakamoto, they ran this exact playbook. They aggressively accumulated over 5,000 Bitcoin. By doing that, they basically changed their entire corporate value to the wild price swings of crypto. By March 2026, their treasury was sitting at roughly $345 to $390 million, officially making them the 19th largest corporate holder of Bitcoin. But, and this is the kicker, that massive hoard was entirely bought with borrowed money.
Section 3. Enter the arbitrageurs.
Now, here's where things get super interesting. This leverage machine has a hidden engine running in the background, fueled by Wall Street hedge funds. The market isn't just sitting back watching. Hedge funds buy up those convertible bonds, but they absolutely do not want the risk of the stock tanking. So what do? They immediately short the stock, constantly rebalancing their positions through a process called gamma hedging. If the stock rises, they sell shares. If it falls, they buy. They aren't betting on the company, they are literally trading the volatility itself.
As George's paper mathematically proves, this constant trading loop acts like a giant funnel. It takes the inherent chaotic volatility of the Bitcoin market and forces it directly into the company's equity. The dynamic hedging by these arbitrageurs acts as a transmission mechanism. Every sudden spike or crash in Bitcoin is magnified into the company's stock because these hedge funds are relentlessly buying and selling to stay neutral.
Section 4. The liquidation spiral.
All right, this brings us to the scariest part of the explainer. This is where the so-called infinite glitch mathematically implodes. Because debt, unlike equity, always comes due. The whole house of cards hinges on one terrifying question. What happens when that debt matures, but the stock price has fallen too low for the bondholders to convert their debt into shares? If the stock is soaring, everyone's happy. But if it crashed, that is the glitch's fatal flaw. George lays out what he calls a lethal fire sale dynamic. It's a 5-step doom loop. First, the stock is down, so bondholders refuse shares and demand cold, hard cash. Second, the firm actually has zero operational cash flow, so they're forced to liquidate their Bitcoin. Third, dumping massive amounts of illiquid Bitcoin crashes the open market price of Bitcoin itself. Fourth, because the firm's value is chained to crypto, that dropping price crushes the stock price even more. And step 5, total insolvency. It's a self-fulfilling prophecy.
Section 5. Nakamoto's bitter reality.
Let's yank this out of the academic theories and look at the bitter reality Nakamoto faced in early 2026. They weren't just a model on a whiteboard anymore. They were living the glitch's collapse in real time. The machine had stalled. By March 2026, Nakamoto was forced into selling 284 Bitcoin, bringing in roughly $20 million. And here is the worst part. They sold it below their weighted average cost basis of about $118,000 a coin. They weren't cashing out profits. They were taking a loss just to keep the lights on and fund basic working capital. Once they lost the ability to print new debt to fuel the glitch, they crashed headfirst into their actual business fundamentals. And the numbers don't lie. Those fundamentals were terrifying. Remember that massive chasm? They had just $2.6 million in operating revenue up against $128 million in operating costs. You literally cannot bridge a gap like that unless you constantly issue new debt, and the market had completely slammed that door in their face. It's exactly like this quote from the financial press pointed out. The glamorous leverage machine of the infinite money glitch had devolved into a desperate scramble to liquidate assets just to survive. They went from being the darlings of Wall Street, hoarding digital gold, to a distressed company pawning off the family silver just to pay the electric bill. Which leaves us with a chilling final thought for today. Nakamoto isn't an isolated case. There are roughly 200 other public crypto treasury companies out there right now playing this exact same game of financial engineering. They are all relying on convertible debt to buy highly volatile assets. So the big question you need to walk away with is this: how many of them are quietly inching toward this exact same catastrophic liquidation spiral as we speak? Thanks for watching today's explainer, and remember to always keep a close eye on the fundamentals.